We always again bring one stock again which again looks interesting from medium term to long term here, and today we are going to put the spotlight on Ramkrishna Forgings. The company is seeing a robust US demand outlook and a strong traction in the commercial vehicle sales. The question here is it the right time to add this stock to your portfolio? What are the brokerages making of this counter? Joining me to discuss all of that is Abhishek Jain, the Senior Manager at HDFC Securities. Abhishek, welcome to the show. Now, first up, help us understand again what are the drivers at present behind Ramkrishna Forgings? Why do you like the stock?
Basically, Ramkrishna Forging is the second largest forging players in India, mainly supply for the MSCVs, and we expect the company will be the key beneficiary of strong traction in MSCV demand with continued shift towards a higher tonnage vehicle. Basically, we are positive on the Ramkrishna Forging. There are the three main factors. First is the change in product mix, second is the margin expansion, and third is the focus on the LCVs, passenger vehicles and non-automotive segment. So with the ramp up of its heavy 12,500 tonnage press units, the company has increased its capability in manufacturing heavy and critical forged products like front axle, ball crank, connecting rods, crankshaft and the knuckles. As we know that ROE of large CV presses are higher than the smaller presses, driven by basically three factors. One is the gain in tonnage is greater than the gain in cycles, and second is they have a higher realization, and third is the break even in large presses is lower, around 25 to 30% versus the smaller presses. So, and in addition, as per the change in the axle, recent axle load cap, there will be a requirement of the heavy and bigger axles. So that will also improve the content per vehicle of the company. So so these are the few factors, key drivers. Apart from this, the revenue contribution from oil and gas and railways around 2 and 5%, and which is expected to increase to 4 to 10% in the coming in FY19. So overall, we expect that because of the change in the product mix, margin profile will improve, ROE will also improve, and stock is also available at a very cheap valuation at around 14-15 times of FY20. So
right. Abhishek, the question will be, I want to ask you more on the margin trend here. But the question here is, when you say it's available at a cheap valuations or inexpensive valuations here, what is the relative comparison again you'll be making? Like what will be the next closest peer, and what is sort of average valuations again, valuation multiples will be comfortable vis-a-vis again where it is trading right now?
So if we talk about the its peers, that is Bharat Forge. And Bharat Forge is the company, Ramkrishna Forging has a lower margin compared with the Bharat Forge because of the company is highly dependent upon the domestic business, and there is a lower sales of the non-automotive business. So if we compare with the Bharat Forge, there is a non-automotive segment contributes around 38%, while Ramkrishna Forging non-automotive segment contributes 18%. However, if we compare with the valuation, Bharat Forge is trading at a 26 times of FY20 earnings. So we expect that the company will continue to trade at a discount to the Bharat Forge, but the discount right now it's available of around 120% kind of the discounts. That discount will narrow down, and we expect that around 24% earnings CAGR in Ramkrishna Forging in next 2 to 3 years. So we have given a multiple of 18 times of September 18. So that is around 60% discount, 60-80% discount to the Bharat Forge.
Right. Even if I was looking at your return on equity trend again as a forecast trend again, FY19 roughly 15%, FY20 15.7%, and FY21 16.7%. A company usually again which has a rising return on equity trend, the stock price actually performs, it outperforms the markets here. So Abhishek, my question to you is, what's your estimate in terms of the margin trend for the company? Because I would assume again the return on equity is going up, so there should be higher capacity utilization, as the margins could also be improving. So what is the confidence behind that?
Basically the current capacity utilization is around 70%, and that will expected to reach around 100%, and the company would be able to stretch its capacity utilization to 110%. So we expect that margin profile will improve from here on, but on conservative side I have taken around 20% kind of the margin, even if the company has already shown a margin of 21% in first quarter FY19. So we expect that in the coming year, once the company will expand its business into the passenger vehicle or LCB, so there will be some margin pressure maybe happen, but again there will be upside risk in our margin profile.
Right. So company again which is getting into complex forgings, again the margin profile starts becoming better. Then also again the sort of clientele is expanding, going into higher tonnage trucks again, or tonnage vehicles again. So that again basically is positive. So those are the driving factors. Abhishek, the next question here is, and a lot of investors, they will be thinking it's an exporter, it exports again to its clients outside of India also, and the currency is depreciating. So what's your view on the currency depreciation benefit, if there is any, or you think the clients perhaps would be renegotiating the contracts?
So basically around 30% revenue comes from the export. So the company will get some benefit in the export of depreciation of rupees. But on the other side, there is a debt of around 400 crore, that is dollar denominated debt. So we expect that net there will be some impact of the currency depreciation on the company.
Right, and if I want to ask you again, what is the sort of average earnings growth you are looking for the company over the next 2, 3, 4 years, and what's the target price you have at present?
So we are looking around 20% or 24% kind of the bottom line growth from FY19 to 21, and we have a target price of 908, that is based on the 18 times of the September 20 earnings.
Right, and Abhishek, thanks a lot for coming on the show and sharing insights into Ramkrishna Forgings. About 2 years back, again, this company actually was struggling in terms of stock price performance also. Now, again, basically, as Abhishek was highlighting, the drivers actually are coming into place. At present, stock is around 700. It's 5%. Basically, the returns again have been in terms of today's performance here. But broadly, again, the target, as Abhishek was pointing out, according to him, is 908. So again, he indeed expects a sort of continuation of our performance by the company here. So that was Ramkrishna Forging from the Auto Pack here. And that's the consensus call again for you right there on the screen, 964 again. We were again showing you all the brokerage houses, again the target prices, and that's right down your screen again, almost HDFC SECURITIES 1058, Anand Rathi. So buy rating, that's a consensus buy rating across the brokerage houses. Elara again basically has the highest, 108 as the target, and then again basically we have Anand Rathi 904, HDFC again had 908, and between 900 to almost 1100 again, it's a very bullish consensus view on Ramkrishna Forging here. So that was Ramkrishna Forging, but now again let's shift the focus and put the spotlight on the pharma space here.